The relentless increase in stock prices without fundamental backing could lead to a stock market bubble, the RBI has warned in its report. Is the RBI's concern valid? The price of equity has surged to record highs, with the Sensex touching a peak of 52,154 on February 15th. The RBI believes that this is a 100% increase from the slump before last March nationwide lockdown and a 68% increase over 2021. The central bank says that this could pose a risk of a bubble as the GDP contracted by an estimated 8% in 2020-21. It is important to remember that the stock price index is mainly driven by money supply and foreign portfolio investor investments. Economic prospects of companies also play a role, but the impact is relatively less compared to money supply and FPI. This assessment shows that the liquidity injected to support economic recovery can lead to unintended consequences in the form of inflationary asset prices. It may require calibrated unwinding once the pandemic has subsided and the real economy starts to recover. The RBI report said that considering the above expectations and earnings growth of corporates, the stock prices cannot be explained by fundamentals alone. There is a deviation from the actual price to equity ratio from its long-term trends, and that shows that the ratio is overvalued. Measure of dividend yield also signal that the markets are getting overpriced. A look at the rise in equity prices from 2016 to early last year shows that a fall in interest rates and equity risk premiums has helped boost the markets. The increase in forward earning expectations contributed to, but to a lesser extent. The ERP spike due to the COVID pulled down equity prices sharply to compensate for the increased risk. What should we learn from this? Geojit Financial Services Vinod Nair says that the central bank has noted that there is a disconnect between the market and economy due to COVID. He noted that the equity market is valued based on its future earning growth proposition, which is solid for India today. High liquidity does help the market, and RBI has reaffirmed its supportive stance till the economy recovers.